I'm about to show you two candle businesses. Both launched with an identical $8,000 in capital and both generated exactly $35,000 in revenue during their first year. Yet one of them is completely out of business by month 18, while the other is scaling smoothly to $180,000 in revenue by year 2. The difference between them is not luck, it is not marketing talent, and it is certainly not a better scent formula. It comes down to a single spreadsheet mistake that killed one venture and saved the other. Today, we are breaking down the exact profit and loss statements, the underlying unit economics, and the precise financial mechanics that separate the businesses that scale from the ones that silently collapse on its own. This is the Candle Business Breakdown series. If you are truly serious about breaking free from your corporate employment and launching your own venture, a low capital, high margin business model with massive growth potential and its structural scalability is exactly what you need. This model relies on inventory light operations, lean manufacturing, and extreme capital efficiency. I highly recommend you watch this entire video and take detailed notes. There are countless videos on YouTube showing people pouring wax into basic molds and claiming to make $40,000 a year. But those narratives are fundamentally detached from reality. Building a genuine, sustainable brand does not happen that easily. We have audited and mapped out a total of 12 strategic sections covering your journey from day 1 of pre-launch to your formal launch. Advanced manufacturing frameworks, corporate finances, inventory modeling, production scaling, sales pipelines, revenue optimization, organized shipping and logistics, the core underlying mathematical formulas, vendor credit recovery strategies, distribution channel metrics, and your ultimate exit strategy. We are covering absolutely everything in this series. However, please remember that this video is only part 1. It establishes the critical financial foundation and provides the numbers that prove whether this business model works or fails. Part 2 will guide you through the actual execution, including the specific distribution strategies that prevent bankruptcy and the precise channel selection that determines whether you generate $8,000 or $80,000 in your first fiscal year. We will examine the exact sequence successful candle brands utilize, which stands in stark contrast to the sequence that destroys most startups. Subscribe to the channel right now so you do not miss it, because skipping part 2 is exactly where most founders make the $15,000 operational error that could have easily been avoided. Let us begin with the brutal truth of the marketplace. The candle market is highly fragmented, meaning there is no single winner that controls everything. Instead, the industry is split into 3 distinct operational tiers. The tier you choose to position your brand within will dictate whether your company survives or goes bankrupt. To prove this, I'm going to show you the real revenue numbers from actual public filings, and then we will look at the exact financial structures that matters for a lean startup. Let us analyze Bath & Body Works for the fiscal year 2025. The reported net sales reached $7.29 billion, managed across a massive inventory ecosystem. Their standard retail price ranges between $24.5 to $27.95, which they frequently discount to a promotional range of $12 to $15 during their major sales events. Their market positioning is purely volume-driven, highly seasonal, and heavily reliant on deep discounts. Now let us analyze the underlying ecosystem. At their massive manufacturing scale, their cost of goods sold per candle is approximately $2 to $3, while their corporate-wide gross profit margin hovers around 44% after accounting for retail store lease cost, occupancy, and massive logistics infrastructure. Their raw product markup before storefront overhead sits at an astonishing 85% to 88%. So what is their winning formula? They operate at a scale that allows them to command the entire supply chain through private label manufacturing. They source raw paraffin and custom glass at an extreme volume and they differentiate their brand through rapid product turnover by launching over 200 new fragrances every single year, alongside exclusive seasonal collections and proprietary patented formats like their signature 3-wick candles and wallflowers plugins. They compete on mass accessible fragrance innovation rather than generic off-the-shelf formulas. What does this mean for you as a startup? If you attempt to compete directly in this mass market tier, you will lose immediately. You cannot match their scale and you cannot beat their massive pricing power. Their corporate marketing budget alone is larger than your entire projected lifetime business revenue. Do not even try to play their game. I'm not saying this to demotivate you. I'm sharing this so you remain practical. In business, you must leave your ego at the door. You stay grounded, protect your margins, and grow consistently without entering the crosshairs of dominant market-leading competitors. This brings us to independent scaling brands, often referred to as indie brands. These are private-owned enterprises that remain entirely free from the control of massive conglomerates or aggressive venture capital firms. Scaling an indie brand means growing a small, focused operation to significantly increase revenue and distribution footprint without sacrificing your original brand identity, creative passion, or core niche community. Let us examine the audited benchmarks for this tier. These successful mid-market brands generate an annual revenue ranging from $5 million to $25 million. Their average retail price sits firmly between $42 and $58 per unit, reflecting a premium direct-to-consumer and selective boutique positioning. Looking at verified financial disclosures, their manufacturing cost of goods sold per candle ranges between $5.50 and $7. This yields an exceptional gross margin profit of 65% to 75% when selling retail and 50% to 60% when selling wholesale to partners. Their customer acquisition cost typically ranges from $28 to $42, balanced against an impressive customer lifetime value of $180 to $240. This lifetime value is driven by highly loyal cohorts or average 4 to 5 repeat purchases over the relationship with the brand. But what does this mean for you? This is your exact lane, not because it is easy, but because the mathematical model actually functions perfectly and delivers true profitability at scale. In stark contrast, we must look at the hobby brands which currently make up over 90% of all candle listings on Etsy. Their financial metrics reveal a tragic pattern. These operators generate anywhere from $500 to $15,000 in annual revenue. They price their candles far too low, typically between $18 and $28 per unit, and they operate without any coherent customer retention or marketing strategy. Their production cost of goods sold ranges from $4 to $6 per candle, leaving them with an unstable gross margin of just 40% to 50% before factoring in shipping or platform transaction fees. Because they do not understand modern ad placement, their customer acquisition cost skyrockets to between $50 and $80. They are rapidly burning through cash, and because their product experience is unrefined, their customer lifetime value is stagnant at just $45 to $65. This means nearly all of their buyers are one-time purchasers who never return. Let us look at the devastating math of a hobby brand. The owner spends $60 to acquire a single customer. That customer generates a meager $12 to $15 in gross profit on their first purchase and never buys again. This leaves the business with a net loss of $45 to $48 on every single customer acquired. These creators believe they are building a real business, but in reality, they are merely subsidizing a personal candle making hobby using their hard-earned personal savings. Now I wanted to show you the exact strategic pivot point that determines your long-term success. It has absolutely nothing to do with how good your candle smells. It depends entirely on your economic positioning in the market. Let us audit 3 specific business models based on a standard 1-year operation. Let us analyze our year 1 projections under a pure premium direct-to-consumer model. We will set a conservative monthly target of 200 units, selling at a premium retail price of $42 per unit with a production cost of goods sold of $5.50. You generate a highly attractive gross profit of $36.50 per unit, representing a raw unit margin of approximately 87%. On an annual basis, this volume delivers a top-line revenue of $100,800. Your total cost of goods sold amounts to $13,200 while yielding a total gross profit of $87,600. Now we must look at the real marketing metrics. If your customer acquisition cost through digital advertising is $35 per customer, acquiring your target base of 200 customers per month requires an advertising spend of $7,000 monthly, which translates to a substantial $84,000 over the year. When a customer is highly satisfied, they will average 4 purchases per year, bringing their first year lifetime value to $168. This sets your lifetime value to acquisition cost ratio at a very healthy 4.8 to 1, well above the baseline industry viability standard of 3:1. Next, we must factor in your monthly fixed operational expenses. Your digital infrastructure, including your Shopify platform and Klaviyo email automation, costs $350 per month. Renting a professional climate-controlled storage space to protect your wax inventory requires $1,200 per month. Commercial product liability insurance adds $120 per month, while operational utilities average $300 monthly. This brings your total monthly operating expenses to $1,970, which aggregates to $23,640 per year. Custom product packaging is already fully absorbed into your unit cost of goods sold. Now, if we look to the year 1 profit and loss statement, we see that gross revenue comes to $100,800 and total gross profit comes to $87,600. Calculating the expenses, cost of goods sold comes to $13,200. Customer acquisition cost comes to $84,000 and fixed operational overhead comes to $23,640. Thus, net operating profit for year 1 calculates to negative $20,040. The uncomfortable truth that nobody tells you is that a properly structured direct-to-consumer business will show a net financial loss in its first year. This is entirely normal. By month 12, you have successfully built a clean data infrastructure containing 2,400 highly valuable customer lifetime profiles. In year 2, when you maintain those original customers and add 300 more per month, the financial model completely transforms. With 500 total active customers, assuming 80% are returning buyers and 20% are newly acquired, assuming 1 piece is sold to each customer, that's 500 orders per month or 6,000 orders in that year 2. With the same retail price of $42, your annual revenue scales rapidly to $252,000. Now, because of these repeat buyers, your marketing costs drop significantly to just $3,500 per month, since you are primarily remarketing to an existing warm audience via email rather than paying high acquisition costs for cold traffic. Your business flips into heavy profitability almost overnight. Where the total customer acquisition cost was $84,000 in year 1, it is now $42,000 in year 2. By keeping your monthly marketing fixed at $3,500 to feed the top of the funnel, your blended cost to acquire a total order plummets from $35 down to just $7 per order, immediately pushing the business into net profitability. Now let us contrast that with Model B, which focuses entirely on selling wholesale to retail boutiques. In this model, your monthly target is 300 units sold in bulk. Your wholesale price is set at $20 per candle, which cuts your unit revenue in half compared to retail. with your manufacturing cost of goods sold remained steadily at $5.50, your gross profit per unit drops to $14.50, representing a 72.5% gross margin on your wholesale contract. Annually, this model generates $72,000 in gross revenue, incurs $19,800 in production cost, and leaves you with a total gross profit of $52,200. To acquire these retail store accounts, you must invest in professional sales representation or pay platform commissions on wholesale marketplaces like Fair. This sales acquisition and trade marketing cost averages to $2,000 per month or $24,000 annually. Adding $3,000 per month for wholesale product samples and unrecoverable presentation materials brings your total account acquisition cost to $27,000 annually. This means your customer acquisition cost ranges between $450 and $600 for every sustainable boutique account you secure. Your monthly fixed overhead is also structurally higher due to bulk material management. Bulk warehousing requires $1,800 per month. Enhanced commercial liability insurance costs $200 per month. Specialized industrial filling machinery adds an amortized $300 per month, and utilities scale to $400 monthly. This brings your fixed operating expenses to $2,700 per month or $32,400 annually. Now we will check the net operating profit or loss for this wholesale business model. And in order to do that, we subtract the cost of goods sold, which is COGS, and operating expenses, which is OPEX, from the total revenue, which comes to negative $7,200. While an operating loss of $7,200 sounds manageable, the hidden trap that completely destroys wholesale startups is cash flow timing, especially standard net 60 payment terms. This means you must purchase the raw materials, pay for production, and ship the finished candles to the boutique today, but you are legally required to wait a minimum of 60 days to receive your payment. During those 60 days, your fixed operations do not stop, and you must fund the manufacturing for your next consecutive monthly batches. If you are shipping $6,000 worth of bulk inventory every single month, you are structurally required to maintain a permanent $12,000 cash flow just to absorb the billing lag. This is exactly why the pure wholesale model fails for bootstrap founders. Wholesale is a highly effective scaling mechanism for established businesses that already possess over $50,000 in liquid working capital. But for a lean startup, the immense cash gap between paying suppliers in 14 days and receiving retail payments in 60 days will completely break your bank account. This brings us to our absolute winner Model C, which utilizes a balanced hybrid approach consisting of a 50-50 unit volume split between direct-to-consumer and boutique wholesale channels. This specific configuration provides immediate retail cash flow to fund day-to-day operations while building highly predictable bulk order volumes from wholesale accounts. This structural balance completely eliminates your reliance on a single sale channel and significantly improves your manufacturing forecasting. Let us look at the year 1 numbers for this hybrid setup. Your target volume is 240 units per month. Split this evenly into 120 premium direct-to-consumer units and 120 wholesale units. Your retail pricing remains at $42 and your wholesale pricing remains at $20. This split generates $60,480 in annual direct-to-consumer retail revenue and $28,800 in boutique wholesale contract revenue, bringing your consolidated top-line gross revenue to exactly $89,280. Your annual cost of goods sold at $5.50 per unit equals to $15,840, leaving your business with a total gross profit of $73,440. Your blended marketing and acquisition spend is highly optimized, acquiring 120 retail customers per month at a $35 acquisition cost requires $4,200 monthly or $50,400 annually. while wholesale relationship marketing requires a steady $800 per month or $9,600 annually. This fixes your total marketing spend at $5,000 per month or $60,000 annually. Your fixed operational overhead is compressed to $28,000 for the year. In total, $88,000 in marketing and operational overhead annually. Now, if you calculate the net operating profit or loss for year 1, it comes to negative $14,560 of operational net loss. This seems to be a bad decision, but in reality, it is not. Because retail or immediate cash generated through direct-to-consumer gives liquid working float, and this is the fundamental advantage of the hybrid framework. Your immediate retail cash flow is strong because your direct-to-consumer buyers pay instantly at the point of sale. They actively fund the net 60 working capital requirements of your wholesale orders, cutting your net cash gap down to less than $4,800. When you cross into months 14 through 18, your early direct-to-consumer cohorts naturally transition into a highly profitable repeat buyers. This structural pivot allows a hybrid brand to reach true corporate profitability months ahead of any pure wholesale competitor. To make this extremely simple to you to understand, watch this. When a D2C customer becomes a repeat buyer, your customer acquisition cost or CAC drops to 0 because we will leverage free email marketing. Now, in order to calculate the D2C and wholesale repeat unit price, we subtract cost of goods sold and customer acquisition cost from unit price. Thus, we get $36.50 for D2C and $14.50 for wholesale. This clearly shows that every D2C repeat sales generates 2.5x more profit than wholesale units. Having said that, profitability on paper means nothing if your bank account is empty due to manufacturing lags. The D2C cash lag is of 0 days because customers pay instantly online, funding next month's raw materials, while the wholesale cash lag is of 60 days or the net 60 terms lockup, which means more than $12,000 in cash flow per 300 monthly units shipped. That is why I said that true profitability comes from a hybrid model which gives 2.5x higher repeat margins with instant cash injections. It hits its financial crossover point much faster. Hybrid model reaches true profitability in 14 to 18 months, which is 1.5 years, because the higher margin H2C repeat pool scales up and completely offsets fixed overhead, while pure wholesale model delays until month 22 to 28, which is more than 2 years, because the business must constantly burn cash out of pocket to fund the 60-day inventory gap before seeing net profit. In our next video of this Candle Business Breakdown series, we are diving into the absolute backbone of any physical brand, the supply chain. We will map out the hidden mechanics of global logistics, break down the inventory financing crisis that destroys cash reserves, analyze the true unit economics of scale, and pinpoint the exact structural profitability inflection point where your business finally starts paying you back. Everything that we are uncovering in this series is real-world, on-the-ground operational truth. These are the exact mathematical frameworks and corporate data structures that elite management consultancies charge hundreds of thousands of dollars to build, and I am handing them to you entirely free. All I ask in return is that you take this data, take thorough notes, and take actions. Don't make a 6-figure mistake by missing the next installment. Hit subscribe, turn on notifications, and I will see you in part 2. We'll meet again.